No tax equals more growth. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. Chapter 9 of my book, The Tax Bomb in Your Retirement Accounts and How the Roth Helps You Avoid It. Chapter 9, No Tax Equals More Growth. So if you like what you see here, subscribe down below. Subscribe, hit the bell to be notified for future content as well, because we're doing at least a video a day, actually 2 or 3 a day now. And we're still halfway through here. So no tax equals more growth. Traditional IRA growth is stunted by tax. And I think a lot of people overlook this, which is one of the reasons I wrote the book. The Roth has no RMDs, which means it can grow for as long as you and your spouse are alive. No RMDs, no required minimum distributions, means no tax, which means you don't have to ever touch the money. You cannot get the same growth potential in a traditional IRA. It's just that simple. You can't. Because you're mandated to take distributions. So think about it like this. You and your spouse are both 68 years old. What is better to have? A tax-deferred account worth $100,000 or a tax-free account worth $75,000? Tax-free account is. Seems counterintuitive. I mean, $100,000 in one end and $75,000. $100,000 is worth more than $75,000. But the facts are the entirety of that $75,000 is yours, where the $100,000 has a lien called the IRS and whatever your state income tax is as well. Slowly at first, but in a few short years, those RMDs are going to grow and grow and grow. And at some point, your account is going to be nearly depleted. Now, you have to be pretty old for that to happen and well into your 90s. But the facts are $75,000 with no lien. 100,000 with a lien, 100,000 is going to start getting drawn down by gravity, and this 75,000 is going to keep going up and up and up. One could argue that you could take the RMDs from your tax-deferred account and invest them in a side account. That's absolutely true. I do talk to people all the time. They have required distributions, but I don't need them. It just sits there. I mean, they just sit there and say, I don't need that, so I put in a side account. That's true. And you could theoretically, that would happen. But remember, first, you got to pay tax on those required minimum distributions, or RMDs. And secondly, your side account may have its own tax consequence. Even if you remain in the 10 or 12% tax bracket, in the chapter we just talked about, chapter 8, I just did about how you can remain in the 10 to 12% tax bracket and pay 0 on capital gains and 0 on qualified dividends, but you still pay tax as ordinary income on any interest earned. And here's the problem, my friends. Interest earned goes on to your bottom line of your 1040, your line 37. And what does that do? It could make your tax brackets higher, up into the 22%, which means if you got a big distribution from bond interest, you have more taxable income. More taxable income could put you in a higher tax bracket, which means what was previously non-tax capital gains, long-term and qualified dividends, could now be subject to income tax simply because you're in the 22% tax bracket. And that's exactly what I talked about in chapter 8, this last chapter. So go back to that episode, chapter 8. Because there are no RMDs for a Roth can pass from one spouse to another without ever being touched. So I have a Roth, $75,000. We'll just say it grows at 7% a year. Let's say I'm 68 years old. So when I'm 78, it'll be worth $150,000. When I'm 88, it'll be worth $300,000. Right now, my wife gets it. We'll say she's 78. She's 10 years younger than me. For instance, I'm trying to calculate this in my head. $300,000. She gets 7% a year. It'll be worth $600,000 when she's 88. When she's 88, it'll be worth $600,000. And then let's say she dies. The kids get $600,000 tax-free. You're just not going to get the same thing in a traditional IRA, because once you hit that 70.5, you and your surviving spouse are going to have mandatory distributions. Like I said in the book, we're talking potential for decades of tax-free growth. Now, what's going to happen? My kids inherit that $600,000 Roth IRA. Yes, they are going to have RMDs at that point, but they're not going to have to pay tax on it. So that's not a bad thing. It's still decades of tax-free growth. When non-spouses inherit an IRA, they do have RMDs. That's what we talked about. But even those RMDs are tax-free. Roth simply cannot be beaten when it comes to generational tax-free wealth. It just can't. Generational tax-free growth, just can't. You can't get that on the traditional IRA. You can't. All right, so I hope you find this informative. If you like what you see here and you want to get the book, Go to heritagewealthplanning.com. You'll get a pop-up. Will jump up. You can get the PDF version of the book for free. That'll never go away. I'll keep that up there until probably I'm blue in the face because I think the book is that valuable. You can get the hard copy. It's $5.99. Hard copy, you get the book. Just go to Amazon. Yeah, well, not a hard copy, it's a paperback. And of course, like I said, Kindle Unlimited is always free. And then after today, the Kindle version I think it's $4.49. So if you want to pay a price, man, more power to you. I'll make big bucks off. I make a little bit, so I certainly hope you pay for it, but you don't have to. There's many, many ways to get that for free as well. So don't forget to visit Heritage Wealth Planning. If you like what you see here, subscribe. Comment and thumbs up always help me. That tells YouTube, the algorithms, that said, that guy, Josh, he's putting out some good stuff. We should probably send that to other people to see as well. So I'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.